Hello, lovely people. How are you doing out there? I'm Kate Hill, and I am here as always to give you the best, unbiased and honest commentary about our property markets, along with some really awesome hints and tips. So as always, stay tuned. Now, I know this might not sound very compelling, but I can't stress enough how important this is. All property investors need to have a very close understanding of what their own particular risk profile is. There are some very clever and skilled salespeople out there, and it's easy to get excited by the prospects property investment provides, particularly given the strong returns of recent times. But as well as going up, the market can go down, and it can cause devastating issues for those who are not properly prepared. So while property can be one of the safest ways to invest money, you can also get it really, really wrong if you're not careful and lose a lot of money in the process. So you do need to conduct proper analysis of your own particular risk profile. This should be considerations around your age, your work, your financial position, and prospects, including your existing equity or deposit. All of this needs to be included. These things and more need to be taken into account and accurately analysed in realistic detail to determine exactly what level of risk is suitable and comfortable for you and your circumstances. And when I say level of risk, I mean things like the potential cash flow of property, the age of the property, how much maintenance are you going to have to do, the area that the property is in can be a risk. There are risks such as buying in the wrong market at the wrong time or overextending yourself. A drop in house prices can leave you in a position of what we call negative equity, which means that the amount of money you owe on the property is more than the current value of the property itself. There is an argument that property investing is safer than the stock market because property will always be there no matter what. You're always going to have a physical asset. So many feel that they can ride out any downturn in the property market if they can keep their eye on the longer term vision. But still, all investors need to assess their risk profile to work out how they will manage if things go badly economically, either for themselves or for the economy as a whole. If you don't adequately assess your risk profile using the guidance of an experienced and qualified property advisor, for example, you can easily end up purchasing property that restricts your capacity to grow your portfolio in the future. If you end up buying a high-risk investment that turns bad, you can end up in real trouble, both financially and emotionally. Now, sadly, one of the big issues for investors is when they haven't done enough due diligence or know the market or industry well enough. The first property you buy can often make the biggest impact on your overall property portfolio success. If it goes wrong, people often don't have as much backup to access cash and can end up losing a large chunk or all of their investment if they are stuck with no way to pay their bills, mortgages, and costs. And it's not just the property market dropping. You've got to consider potential issues such as your health, the health of your partner, your family as well. This often gets overlooked. You've got to build in financial buffer. It's important to help you deal with any unexpected circumstances. Losing your job is another risk, of course. Allowing for the fact that this might happen means you can plan for it in advance. Managing your cash flow is very important. Keep a budget. Get to grips with the what ifs. This might also minimize your anxiety in any of these circumstances because you will have then planned the approach and you'll have considered the impact financially of those potential circumstances. Having said all of that, you don't want to be that neurotic and obsessive about potential risks that you never move ahead with anything at all. Your personality plays a factor in all of this too. You might be more conservative or more of a risk taker. Your attitude to money also affects your risk profile. Do you run a tight budget and save money every month generally, or do you live from week to week and see if there is anything left at the end? Any investment requires discipline, organization, focus, relevant skills to interpret, define, and learn from that research so that you can develop your strategy. If you have investment experience, then this can also affect your attitude and risk to risk. If you have had a bad experience with an investment in the past, then you might be more hesitant to make the most of the best opportunities out there for you right now. On the other hand, if you have had a fortunate and positive investment experience and successes, or seen it work for others seemingly easily, you might be blinded by optimism and overconfident based on a previous market condition. It's really important to be honest with yourself about what you're feeling. Now, you can't also ignore the gut feeling and instinct. We all get a feel for an area or a property, but you must never make emotional decisions and ignore the data. So before you do your first deal, to make sure you spend time getting educated and totally across what you're comfortable with, what you need to know, the best tools to help you and have a clear view of your strategy and goals. Over the last 60 years, we've seen massive gains in many global property markets, and property is considered a growth asset. But downturns do and will happen, especially with the wrong property purchase, whether it be the type of property, the wrong location, or the wrong economic conditions. Now, I study property markets professionally. I do it every day. And you really do need to understand all of this. I can't stress it enough. It doesn't matter whether you're a first timer or a seasoned investor. Having the right research done and building the right team is critical for any investor wanting to grow their property portfolio. Organising the right due diligence, ensuring that your property purchase is statistically appropriate for your particular circumstances and risk profile, and learning the important detail around how best to manage your investments. It's so important to avoid big potential problems down the track and to maximize your chances of success. Successful property investing is a path that now more than ever requires proper care and consideration. Getting your risk profile right and keeping it up to date is perhaps the most important part of all of this. Okay, lecture over. I'm going to keep talking to you about all things property. So don't forget to hit that subscribe button, click the like button if you're enjoying the free content, and I will see you again really soon. Bye.